All right, so are you ready to dive into the world of financial allocation and diversification?
Always ready to talk about making that money work harder.
Yeah, and I was looking through some of the sources we have today, and it just seems like people get so intimidated by investing.
Yeah, it can be pretty overwhelming at first glance.
So let's break it down.
Definitely.
We'll try to keep it simple. What is financial allocation? And more importantly, why should we even care?
Okay, well, imagine building a house. You wouldn't just use one material, would you?
Not if I wanted it to stay standing.
Right, you'd use a mix of things, bricks and wood and concrete and so on, to make it strong and resilient. Financial allocation is kind of like that.
Hmm.
It's all about strategically distributing your investments across different asset classes, things like stocks and bonds and cash. You're creating this portfolio that's built to weather all sorts of market conditions.
So is this like the whole don't put all your eggs in one basket thing?
Yeah, that's diversification, and that's a key part of financial allocation. By spreading your investments around, you're reducing the impact if one of them takes a hit. One of the articles you sent over mentioned this study about how diversified portfolios just consistently outperform the ones that weren't.
Oh, yeah, wasn't that the one where they found that portfolios concentrated in just a few stocks or sectors didn't do so well?
Exactly. That's the
Yeah.
magic of diversification in action. It's not just about avoiding big losses. It also helps smooth out the ride a bit, so you can see more consistent growth over time.
Makes sense. So we're spreading the investments out to minimize risk. Got it. But how much do we actually put into each asset class?
Well, there's no magic formula,
I
unfortunately.
was hoping you had one.
The ideal mix for you is going to depend on a few things: your financial goals, your time horizon, and something we call risk tolerance.
Okay. How about we break that down a bit? What is risk tolerance?
Risk tolerance basically measures how comfortable you are with the possibility of your investments going up and down in value. Some people love a little volatility. They see the potential for bigger gains. Others prefer things to be more predictable and steady, even if it means potentially missing out on some growth.
So if someone gets really anxious seeing those numbers jump around, maybe I should probably stick with those lower risk investments.
Yeah, you got to go with what you're comfortable with. It's all about aligning your investments with your own personal comfort level. Now, there was something interesting in that source material you sent about how people's risk tolerance can actually change as they get older.
Right. It was saying that younger investors with more time to recover, they might be a little more comfortable taking on some risk.
Exactly. They're in it for the long haul.
But as they get closer to retirement, their risk tolerance might go down, and they'd want to shift to a more conservative approach.
It makes sense when you think about it.
It's kind of like riding a roller coaster. When you're young, you might crave those big drops and twists and turns.
The thrill is part of the fun.
Exactly. But as you get older, you might be looking for a more scenic and leisurely ride.
Yeah, you just want to enjoy the view. It shows that this isn't a one-time decision. You have to continually assess your situation, your goals, your risk tolerance, to make sure your portfolio is still working for you.
Okay, so how do we actually figure out our risk tolerance? Is there some kind of test I can take?
There are definitely some questionnaires and assessments you can find online, but those are just a starting point, really.
So what else can you do?
It's important to reflect on your own financial experiences. Think about how you've reacted to market fluctuations in the past. How much are you comfortable potentially losing? And how would those losses actually impact your financial well-being?
It's a lot to consider, but it sounds like it's a crucial step towards building that perfect portfolio.
Absolutely. It's really the foundation for everything else. Once you have a grasp on your risk tolerance, then we can start talking about choosing your investments.
Sounds like a plan for next time.
Definitely looking forward to it.
Okay, so we figured out our risk tolerance. Now what?
Well, now comes the fun part. Choosing the investments.
Hmm.
And that's where diversification really comes in.
And I remember you mentioned last time that it's more than just picking different stocks.
Right. It's not enough to just have stocks and bonds. You got to diversify within those asset classes, too.
Okay, give me an example.
Like planning meals for the week.
Yeah,
You wouldn't just eat pasta every night,
right.
right?
I mean, I could.
You'd want different flavors, textures, nutrients. Same thing with your investments.
You're saying I should spread my money around, not just between stocks and bonds, but within those categories too?
Exactly.
So like instead of putting all my stock investments into tech,
Which is tempting these days.
I'd want to have some healthcare energy, maybe even international companies.
You get it?
That way, if one sector has a bad year, the rest of my portfolio can help balance things out.
And it's funny you mentioned tech, because one of the articles talked about how gold,
Hmm.
has historically moved in the opposite direction of the stock market.
So if tech stocks are down, gold might be up.
Exactly. It can provide a bit of a cushion.
I think they call that correlation, right?
You got it. Correlation is super important when you're diversifying.
So how do I figure out these correlations?
Well, you don't have to just guess. There are tools and resources out there, financial websites, even some brokerage platforms. They give you correlation data, so you can see how different assets have moved in relation to each other.
So it's not all just luck.
Nope. There's a method to the madness. And that brings us to something else that's important. Rebalancing.
Oh, yeah, we touched on that last time. Remind me how that works again.
So remember how we talked about your ideal asset allocation? How it depends on your risk tolerance and goals. Well, over time, your portfolio can drift away from those initial targets.
Because some investments do better than others.
Exactly. Rebalancing is how you bring it back into alignment.
Okay, so let's say I want 60% stocks, 40% bonds. But after a while, the stock market goes up a ton, and my stock portion is now 75%.
That's when you rebalance. Sell some of those stocks, buy more bonds, get back to that 60-40 split.
But wouldn't it feel weird to sell something that's doing well?
It can feel counterintuitive, but it's how you maintain your desired risk level. And it prevents your portfolio from becoming too concentrated in one area.
So it's like trimming a plant to help it grow in a balanced way.
That's a great analogy. And one of the sources pointed out something really interesting about how rebalancing can actually force you to buy low and sell high.
Because you're selling what's gone up and buying what's gone down.
Exactly. You're taking advantage of market fluctuations.
That's pretty cool. But how often should you rebalance?
There's no hard and fast rule. Some people do it on a schedule like quarterly or annually.
Others just wait until their allocation gets out of whack.
Yeah, maybe if it's just by 5% or 10%.
So it's flexible.
It's about finding what works for you.
Mm.
And there are tools to help, like robo-advisors.
Oh, yeah, those things that manage your investments automatically.
Exactly. They can handle the rebalancing for you.
But do you lose control by using one of those?
Not necessarily. They still take your risk tolerance and goals into account. You answer some questions when you set it up, and the algorithm uses that info to manage your portfolio.
So it's not just some random computer.
It's tailored to you. But for some people, a traditional financial advisor might be a better fit.
Okay, so what do financial advisors actually do?
Well, they can be a huge help if you're looking for guidance. They can help you figure out your risk tolerance, define your goals, develop a plan that works for your specific situation.
So it's like having a financial coach.
Exactly. They can also educate you about different investment options, help you diversify your portfolio, even handle the rebalancing if you want.
So they can take care of all the details.
And they can also provide emotional support, especially when the markets are going crazy.
Yeah, it's nice to have someone to talk to.
One of the sources actually mentioned a study about how people who worked with advisors felt more confident and less stressed about their finances.
It's good to have someone in your corner.
But remember, even if you have an advisor, you're still the one in charge of your money.
No one cares more about it than you.
Exactly. You got to stay informed, ask questions, keep learning. One of the sources mentioned a concept called core and satellite investing.
Core and satellite.
Yeah, have you heard of that?
It sounds familiar.
So picture a planet with its moons. The core of your portfolio is like the planet itself. This is the solid foundation. Investments that are there for long-term growth and stability. Think of it like a diversified mix of index funds or ETFs that track the overall market.
Okay, that makes sense. And what about those satellite investments?
Those are like the moons orbiting the planet,
Right.
Smaller, more focused positions, where you can target specific opportunities or themes you believe in.
So it's a way to add some excitement to the mix.
Exactly.
Could be individual stocks and companies I like.
Could be.
Or sector-specific funds.
Maybe focused on renewable energy or emerging markets.
It's a way to personalize things a bit.
And potentially capture some extra growth.
So I get the stability of the core, but I also have the flexibility to explore other areas with the satellite investments.
It's all about finding that balance.
I like that.
And it can be adapted to your risk tolerance.
Someone who's more risk-averse might stick to a smaller satellite allocation,
Right.
while someone with a higher risk appetite could go bigger.
It's all about what you're comfortable with.
Speaking of aligning investments with personal values, one of the sources mentioned ESG investing.
Oh, yeah. ESG is getting a lot of attention these days.
Can you explain what that is?
ESG stands for Environmental, Social, and Governance.
Okay.
It's an investment approach that considers more than just financial returns.
So it's not just about making money.
It also looks at a company's impact on the environment. their social responsibility, and their corporate governance practices.
So I could actually invest in companies that are doing good in the world
Exactly.
and still potentially make a profit.
There are a growing number of ESG-focused funds and ETFs out there.
It's great to see more people thinking about this.
It shows that investors are realizing they can make a difference.
It's not just about the bottom line anymore.
It's about using your money to support things you believe in.
We've talked a lot about the technical stuff today, but at the end of the day, it seems like financial allocation and diversification are about so much more than that.
It's about taking control of your financial future and creating a life that aligns with your values.
It's about having the freedom to pursue your passions, to support causes you believe in, to build the kind of life you want.
And one of the sources highlighted the importance of having clear financial goals. What are some of your goals?
Well, I'd love to travel the world someday, maybe retire early, have the resources to be creative without stressing about money.
Those are great goals. And knowing what you're aiming for can really help shape your investment strategy.
So if I'm planning for early retirement, I might be willing to take on more risk.
To try and reach those goals faster.
But if travel is my priority, I might invest in travel-related companies.
It's all about aligning your investments with your life.
This deep dive has been incredibly insightful.
I'm glad you found it helpful.
What would you say are the key takeaways for our listeners today?
Well, I think the biggest one is that this stuff isn't just for experts. Financial allocation and diversification are tools anyone can use.
To take control of their money and build a better future.
Exactly.
It's about understanding your risk tolerance, defining your goals, and creating a plan that works for you.
And remember, it's a journey. There will be bumps along the way, but with the right mindset and a bit of patience, you can achieve your financial goals.
This has been great. I feel like I've learned so much.
There's always more to learn, but this is a fantastic starting point.
And for those who want more personalized guidance, there are always financial advisors.
Don't be afraid to reach out for help.
Thank you so much for joining us on this deep dive. We hope you found it valuable. Until next time, happy investing.